Hello, everyone. Welcome to another episode of Three Consulting Amigos. Ron Burgess, Ed Lasak, and myself, Ray Anderson. Today, we get the pleasure of watching Ron go through 5 of the 8 drivers that are connected to marketing. And you're going to enjoy this. He does a great job. Without further ado, let me introduce Ron. Ron, take it away.
Thank you very much, Ray. Yeah, we're going to talk about the question that Ed posed to me, kind of a challenge, was what do I look for when buying a business? Which was kind of an interesting exercise for me because while I don't buy a whole bunch of businesses, I've started 5, and Ed and I, and of course yourself too, we've looked at several businesses, we've worked in lots of businesses, and I'm open for, I'm sort of in the market for looking for good businesses, and so it was a fun exercise to see how I would go about that based on the kinds of things that I think are important, mostly from a broad marketing perspective. And of course, the interesting thing is that these are all part of the 8 drivers that drive the value of the business. So let's run through those. So these are the top 5 things I look at when buying a business. So here we have, for those of you who've tuned into the series previously, here we have the 8 drivers. And you can see that they include several different pieces. And this represents the ones that I consider some marketing or touch marketing, which includes market potential, customers, and how sticky they are to the business, growing revenue and margin. Of course, everybody wants to do that. And this is having to do with quality. Primarily, efficiencies are good and productivities is all important, but quality is a big part of selling, because we're always looking at price against quality and a couple of other factors. So that's part of what I look at. And then over here, we've also got forecasting, and the part of forecasting really has to do with what are you going to do with your sales trends and patterns, and how are you going to design those. So those are the ones that we're going to look at today, and you can see that they really are part of the drivers that we talk about. So the first 5 things are right here. Number 1, market size and market share. That shouldn't really be too much of a surprise to anybody, because we want to know if there is a market, and we want to know how big it is, but we also want to know how much business this particular prospective business has, whether it's a teeny weeny amount or whether it's they're in a monopolistic kind of market with maybe 1 or 2 competitors. That's a really important part of it. Second, our sales revenue and margin growth. And of course, I think everybody understands that. The more interesting piece here is margins. There are a lot of marketing people that would say sales, but they would never say margins. But really, that's very important, as we've talked about before, in terms of the different drivers. And then company brand and brand differentiators. Those we'll talk a little bit about. Marketing people like to talk about this kind of thing. It is important. If you don't think it's important, then try to get Coca-Cola out of your mind, or when you're interested in a Pepsi, you're gonna pick something it's not going to be ABC Cola, because you don't know what it tastes like and if you like it. So branding can be very important. Other businesses is not. Bless you. Owner participation in the operation. This is something you might be a little surprised at. We've talked about this extensively in our series. It's really important I was thinking about it at first in terms of the sales team being led by, say, the owner, and we'll talk a little bit more about that, but that's also a pretty important thing. If I'm going to buy a business, I want a company that can run by itself. And digital adoption and scaling abilities. We'll talk a lot about that. That may be a surprise to some. So I'm going to go through each one of these now in a little bit more detail, and jump in, guys, if you've got questions or comments about them. So the very first thing that we look at here is the market size and share. And you can see on the left side of the screen here that you've got kind of a S curve. It's been used in business schools for a long time. In economics, it kind of shows a brand new business where nobody knows what it is. One example is the personal computers. Very few, even though they hit the market with a lot of fanfare back in the late 70s, not very many people knew about what a computer would do, and it grew very slowly over several years before it really picked up steam. But it did eventually pick up steam, and we've grown through this rapidly growing market area for personal computers. A lot of people entered the market. I think there are only reasonably about 5 now global manufacturers of PCs, a few more if you count laptops. But it's consolidated, and it's now a very mature market, this very top part. And so when I'm looking for a business, I want to come into it in this area right here before it's really matured. I don't want to have to sit and wait for years to help people understand what the adoption was. I did that once in the technical business and in the digital marketing business. And we spent these years right over here pretty slow in explaining a lot of things about what is a URL, what's a website, and things that we see very elementary now. We spent a lot of time and people didn't understand it. And then we finally hit this curve and started going rapidly. Well, that's the place that I'd be interested in buying in. I don't want to have to do this slow acceptance. And I don't want to have a dead, old-fashioned business up here that is consolidated into just a few big, tough competitors. One of the more important things in this concept is the margins that you can get. And the reason that it's in market share, the reason that both of those are important is because we know from numerous studies and experts, as well as from the PIMS database and studies done with this database on marketing numbers and marketing results, that there are a couple of things that influence margin. And if you take a look at this here, you'll see in this particular scale over here where it's on quality shows as quality goes up, the margin goes up. And so on this scale, you can see that as the share of the market goes up, margin also goes up. So you've got an increase of double, 2.5 times from the low to the high. But if you can achieve both of those, you get a huge effect, and it jumps up to about 35, 40, 45%. And of course, these are just all averages, and they're shown to show you comparisons. But there are real stories of looking at businesses. And in fact, this comes from a database of marketing numbers. And so what it tells us is that if people see you as having superior quality, and you also have kind of earned a large marketing share, you're number 1 or number 2 in your market, in the small business, that's a real niche market, then what you end up achieving is a much larger gross margin. Now that's really important. We don't have time to talk about it much here. That's really important because if you can achieve higher margins, you're creating more cash, because those margin dollars, have already paid for the variable costs. So once those margin dollars pay for fixed costs, all the increase goes right to the bottom line. So it is a constant battle. It's a supply and demand issue, but it's a constant battle between how much volume do we want or need, and how much margin do we want or need. And that battle is the controller is interested in that, no doubt. The president of the company is interested in that. The marketing person should be interested in that too. Now that rarely happens, but that is a marketing function and needs to have, the best marketers understand this.
Ron, I'd like to ask a question. I don't know if
Yes.
Ed has the same, you know, could you help? Let's say I'm a potential buyer right now, and I'm looking for a regional business, and I know it's big, but I don't really understand whether it fits the PIMS principle.
Mhm.
How would you advise us to, or the potential buyer, to look at the business through the lens of this particular chart?
Yeah, good question. For smaller businesses where sometimes the market is not well defined, you have to kind of jump into the first question, which is, what is your market? And most small businesses tend to think that they need to expand their market because they'll do more business. That's really not true. What you want to do is you want to penetrate a narrower business. If you're in a narrower business and you've got good margins, you've got the money that it takes to capture more business. You've got advertising dollars, you've got salespeople focusing on the right people at the right time. You're buying resources that focus on their issues. You're building new products for those people. If you expand your market too much, you spread your resources, and almost imperceptibly, most business people never realize that they're wasting money because they're trying to expand business by extending the line of business, and it doesn't necessarily grow them. In the marketing literature, there are just hundreds or thousands of cases that illustrate that extending a line is not the long-term way to grow a business. Now, that doesn't mean if you're selling, blue widgets, that you can't sell green and red ones. That kind of a line extension might make sense, but you don't want to sell widgets with wheels if it doesn't have anything to do, with the roller derby market or whatever the case may be. And so you want to be very careful about that. One way to look at that is to determine if you're going to be able to maintain your margins or increase your margins based on your new product development. So the next thing you have to do is you have to spend time looking at who your competitors are. You can do that online today, which we couldn't do before, so there's a huge advantage. And there are lots of resources to get some information about those people, including websites again. And then, of course, you have to keep your ears open all the time to try and identify where people are, talking to your customers and having a continual customer feedback.
I think from an accounting perspective, I think there's two issues to talk about in that area, and that is, number one is a lot of people don't understand their balance sheet. So they don't understand that by expanding in their services or products in the new markets, the impact on working capital, the investments that are required, and the returns, if they don't show a return on investment, it's just not a wise thing to do. Additionally, they don't understand sometimes fixed costs. If you can leverage your operation and not increase your fixed costs and expand new revenue sources and look at your gross profit margin, it might make some sense. But sometimes people expand and before you know it, they double their fixed costs. And they're right in the same boat, and actually their margins diminish. So that's a good.
Yeah, you're exactly right. I'm reminded of a pest control company, pretty nice in size and reasonably successful, been in business for 40 years. And they were so proud of the idea that they were doing business. We're in the Inland Empire here, and it's a pretty big metropolitan area, and there are a lot of people in Riverside and San Bernardino and of course Redlands, and so, but there's also a whole lot of people from Riverside moving into LA, another 40 miles away. So you're talking about millions of people. And so they were very proud of the fact that they were starting to do business out in Pomona. Now that's what, 20 miles from Riverside, somewhere in that region. So I had the discussion with him about, well, why are you doing that? Because he was saying, yeah, we've got a guy out and selling in Pomona now. Well, why? And of course, the answer was, well, we're doing business out there, and we're finding that there's a pocket of business. So I said, well, all right, we'll come back to that. So what we did is we mapped all of his customers and the relative size of the business of all of his customers. And really what we discovered is that, no, that wasn't at all true. They had a few customers out there, but what had happened is that an apartment building owner whose office was in Pomona made a phone call and said, we need you to do all of this work. And they thought that they were doing a huge amount of work with residential. In fact, it was a commercial work. Now, commercial work is fine. And if somebody in Pomona wants to send us work, within the zones that we efficiently do business, hey, that's about as wonderful as you can get. But for him to make the decision to send an additional salesperson out to try and do more business really made no sense. And he was, in fact, investing, just as you say, Ed, investing in this case, fixed costs in order to go get business that was further away, increasing his variable costs.
Right.
The same exact thing happened up in Arrowhead, which is in the mountains about 35 miles away. So what we discovered is that, he was really wasting a lot of money trying to go to places, thinking he was a big business, but he wasn't. He was a local business. So let's see. Let's move on then to the next one, and that's sales revenue and margins, and of course growth for at least 5 years. I'd like to see growth longer back than that if possible. So you want to take a look at the growth curve, obviously, and turn this into percentages to determine if you're growing at, as they say in economics, are you growing at a declining rate or an increasing rate? Well, what you want to know is ideally you're growing at a faster rate, not a slower rate. That's sometimes hard to tell, and there are lots of conditions that can change how that goes. But if you have a nice steady growth, that's a better scenario than an up and down choppy growth, in which can be fine, but you need to analyze that and see where you are. But at the same time, you can buy business by lowering costs. So you want to make sure that the margins are increasing as well. Now, in this example, you can see that because the margin is a percentage of the total revenue, you can see this gap is getting wider. This means the margins are not increasing as fast as sales. So now the question is, well, why is that? And that's a pretty important sort of technical measurement for a marketing person to really understand, okay, why are we growing? What are we giving away? Is it good, real growth, or are we buying that? My old partner used to say, any damn fool can give it away. It's selling it with full price that's difficult to do. Well, that's what this is right here. Okay, next, company brand and differentiators. Some people don't give brand very much credence. And I can understand that. There are a lot of companies where you look at them and you go, doesn't really matter. Oh, maybe a manufacturer of window, well, that's a bad example because we both know a window parts company that's really successful and probably number one. But it might be a manufacturer of any little trivial thing, something to go with cars, some hardware that is little used. And I bought some stuff. I do woodwork, and I bought some stuff from a company that was called the Widget Company, and they sold little teeny, almost trinkets, but you needed to have them if you're building shelves. So, there are all of these interesting companies, and you don't think of brand because you don't really need to know the brands of a lot of those things. But if you look at consumer brands and you try and just ask yourself a question, well, which are the best brands? You kind of can see that by example that no brand really can make a difference. For instance, when we take a look at the top companies in 2019, this list showed that Rolex was number one, Lego, Walt Disney, Adidas. Of course, we all know all of these brands, right? Well, that kind of tells you there's a little bit of success because we know those brands. And if you're asking about Apple, well, they're only a few down. They just missed the cutoff at 5. And on certain years, they've been number 1, number 2. So Apple has a very strong brand. Some people would argue it's the strongest brand. But these kinds of brands stand out because you have an instant understanding of what kind of company it is, what kind of quality they represent, what kind of overall value they represent. So if you're looking at Rolex, for instance, you can simply by looking at the product or their advertising, you can tell this is a kind of a high-end watch company. It is well known for what it does. They keep good time. They are high quality, and all those kinds of things that represent a really great brand. Then on the other hand, you can say, well, so give me an example of a really bad brand. And there you go. Not only is Kmart a really bad brand, the store looks like you wouldn't ever want to go in there. And strangely, you even see cars that are parked there that you're not sure you would want to walk by. So you've got this real interesting dichotomy. You say Rolex to somebody, they have an image. You say Kmart to somebody, they're going, haven't been there in 20 years, don't want to go there, don't even want to know where it is. So there's the difference in brand. Now, in terms of differentiators, you could say, well, let's look at Kmart and the other stores in that category. Well, the top one is Walmart. What do you think about the difference there? They sell the same stuff. Well, maybe they do have a lot of the stuff that overlaps, but the systems at Walmart are head and shoulders above Kmart's. Kmart never made the full conversion to digital. They paid the price. The place is always dirty. Walmarts are almost invariably very clean. They're orderly. They're well thought through. They have an incredible purchasing department that works really hard to try and get the best value for people. You just are not sure what you're going to get in Kmart, but you may feel like you need to take a shower when you come out. There's a brand. If you have, and it's in a sense, it doesn't matter if it's true or true to you, but I know that I don't want to go in a Kmart because I've had such bad experience. I don't even like to be in the area. And I've only been in a Kmart one time in 30 years because 30 years ago, I was so turned off by the brand and what they were doing. Of course, I was in retail, so maybe I was a little bit more conscious about it than others. But there are examples of how brand is important. So if you're buying a company, do you want to buy a Kmart brand? Or do you want to buy a Rolex brand? Now, you're probably not going to buy Rolex, but in some relative way, you certainly don't want the Kmart unless you're going to steal it from the owner. So if you're going to buy Kmart, you got to buy it at way under book value. You got to discount it like crazy because you're going to have to spend a lot of money and invest in changing the brand, in upgrading it, in doing a variety of things in order to sort of fix that image problem. It's so bad that you'd probably have to strip, the first thing you'd do is you'd strip the signs off the building and put something else. It would be better to have a canvas sign that simply said going out of business. That would attract a lot more people than the Kmart sign. So brand does matter. You want to buy a company that if it has brand value, it's going to be worth a little more because it costs a huge amount of money to instill an image in your potential customer's mind. And therefore, if the company you're buying already has that image in its marketplace, then you've got an opportunity to grow that company much faster. Owner participation in operations. And this is one, of course, that I mentioned, we've talked about a lot. And I primarily am focusing in on the sales team. I have had clients where the owners were the primary salespeople, big companies, multi-millions of dollars in business, but they sold big items. And so the owners could literally push the entire company forward by selling very large projects. So, if the owner is the person who's responsible for bringing in business, you have got a big problem as if you're buying that business. And so now the question is, well, how are you going to mitigate that? The average buyer, Ed, you weigh in on this. I would think the average buyer is going to discount the price they're going to pay if the owner is the rainmaker. Does that sound about right?
No doubt about it. That's just way it's going to be. And a lot of those owners, they take great pride in making every decision in their companies. And in reality, they're hurting their companies. Their seconds in control are in control of nothing. They make no decisions. They don't feel comfortable making decisions. And they're only concerned about staying out of trouble with the owner. And a lot of times these owners, they only want to do it their way. They're not open to new ways of generating new profits. And so therefore, you're kind of working with an organization that the owner doesn't want you to participate in that manner. He wants you to go to work, do your job, dig the ditch the same way over and over, and please don't give him any ideas on how to improve operations.
Right. And of course, even if the owner is doing a wonderful job, and he gets hit by a bus, then you're in the same spot because you're relying on one or two people to really push that company forward. So if he was willing to sell it to you and says, oh, no problem, I'll work in the business, well, you're still vulnerable. You better have a big key man insurance policy on that person, like equal to how much you paid for the business.
Yeah, no, and I wanted to use an example. Most of you know John McKay, who founded Whole Foods and recently sold it, but he was in an interview one day and somebody asked him, well, can you tell us how your operators, are able to move the lines through so quickly? And he looked up and he says, geez, I don't have a clue, but I'm sure they do a good job because we continue to grow. And, that while that sounds so exactly what we're talking about, he had built a company that he didn't even need to participate in. And I think that's what we're trying to identify here.
Right, that's right. So the fifth thing, it might seem strange for marketing, but we'll talk a little bit about that. And we're talking about here is digital adoption and scaling abilities. And so scaling might not mean digital necessarily all of the time, but for the most part, I think that all you have to do is take a look at some of the companies that are out there that have grown really big. And you can see that it was their digital capability that allowed them to explode. Certainly this is true with all digital companies, like Google, Facebook. But it's also true with Apple. They manufacture real items that we hold in our hands, and they've used all kinds of digital assists, not only for their products, but for the manufacturing of their products and engineering capabilities to be able to grow rapidly. You can look at Amazon and you might say, yeah, but that's bricks and mortar. They have big warehouses and equipment and all. Is that digital? And the answer there is it's absolutely digital. Digital is what drives Amazon. Sure, they handle physical packages, but besides what you're seeing on their website, they're using digital to shorten the times of just everything that you can think of. Number one, the order process goes directly into the best location for the inventory and where it needs to be delivered to. And number two, it's already starting that process before you even close your browser. I have kind of gone online and then gone to tracking just to see how fast that goes. And I've been surprised that, they'll say that they've placed the order immediately, and then they'll say they've pulled the order sometimes within 5 or 10 minutes. So they've got a robot or a person who've got the information. They know where it's going to go, who I am, where it's going to go, and they're already going to pull that out of the shelves so they can put it into a container, for instance, and then put it on its way either with a robot or in a packing facility, and then before it even gets to the trucks, it's already made the decision as to which is the best truck for it to be on and which company is going to be the one to ship it based on whether or not you're a prime customer, a regular customer, etc. So that all happens digitally. And everything that is being driven in that company is based on digital. So they have driven their business, they allowed it to grow huge because they've built these systems. The digital can expand. Of course, the website was able to scale up simply by adding servers and some software. I'm not saying it's easy. I'm just saying that's how they did it. And then, of course, adding a new warehouse becomes somewhat cookie cutter. But in order to drive it, all they have to do is hook it up to the internet, because the internet and their application software is telling everybody what to do. So those are all cookie cutter. So the additional piece to this is that it's not just being digital, it's using digital to drive the physical world. And so it's systems as well. And so, you know, when you've got somebody turning the cogs, and it's being turned by the digital aspect of it, whether it was ordered online, it might have been designed, it was probably designed on a computer, it was transmitted on a computer, the communication to the customer in 99% of the time is based on sending messages to a cell phone or a computer or an email, perhaps email. And so all these communication devices are happening digitally, and that's what's allowed them to speed up, and other companies. Now, the interesting part here is that small companies are just behind. In the digital business or digital world, they're in the dark ages. It's troubling to me that so many small businesses are so far behind. This is because I believe, this is my opinion, most of these companies are being run by people our age. And most of the people our age don't know anything about digital. And so, yes, the president maybe finally figured out how to run his computer and type his own letter. But that's not really competence in terms of technology. Competence has to be understood at the level of how do you get the metrics from the machine to the decision-making platform, so that the decision-making people can look at the reports and numbers and do the evaluation and make the decisions. And so today we see computer networks in, I guess, most of the people we've worked with have computers of one sort or another. My company has actually built several systems over the years for clients, and in some cases those are actually quite large systems now. And so driving clients into the digital age has been a lot of what my success has been with the rapidly growing companies that are in fact taking over market share and increasing their margins. It lowers costs. You get rid of the paper, you move information faster. It just solves so many problems. It's not without a lot of pain. I get that. It requires training, retraining. It requires people who have good systematic minds, who understand the natural sequence of things and to think creatively. And it also requires, Ray will jump in on this one. It also requires that you get your teams, your people working in teams in order to solve some of these problems. Sometimes these younger people in the business understand that it can be done a lot easier than the owner can. And so looking at the digital adoption is kind of a way to determine if the owners are actually thinking in terms of systemization so that their company can run. If the first thing that you do in a company is that you have to build your own systems, that devalues the company. Ray and I work.
I agree, Ron.
And you and I worked on.
I was just going to say, we've gotten to the point now where it can do so much in terms of even customizing processes and other things. you know, it's important when you talk about digitizing the company and making, you know, even to the front line, you can't communicate any faster than you can with an app and something to be able to let people know when something's wrong or something's going well. So I think it's a very good point.
Right. And you know, today I had a meeting with my dairy client. They're introducing a brand new app, and it's going to do all of the online ordering and that kind of stuff, and that's all great. But the exciting part is the way we're going to be able to communicate with customers through the app. So they'll be able to get push texts and push notifications so that they can tell when, you know, they're not going to get something because it's out of stock. They are going to be late. But especially in this particular case, this area is prone to large snowstorms. And, you know, sometimes you can't get through the snow, and customers want to know, are they going to get their delivery or not?
Sure.
And so that's an important piece. And things happen, like the telephone went down just last Friday. And so they've got 8 customer service people, and literally the telephone calls stopped on a dime. Of course, they knew what had happened right away, but unfortunately, right after that, the internet failed. And so here we are with trying to communicate with 30,000 customers, and we don't know how to do it. We can't be calling them all. Well, this new application will be a redundant system, and they're going to get a notification on their cell phone, and that's likely not going to go down. Of course, it could, but we now are going to have 3 ways to communicate instead of 2.
Cool.
So there are real customer benefits, and customers expect this kind of service today. I'm really quite worried that smaller businesses have not progressed as far as they should have to stay competitive.
On that note, if you are using a system that was built in the 1990s, that you've been piecemealing together, and you compare it to new technology where systems are fully integrated and information passes freely without people having to touch it and re-input it and reanalyze it, there is such a significant improvement in that technology that you really can't even put a pencil to it. It's humongous.
Yeah.
And unfortunately, people think they spent $10 million on a system over the last 30 years, which is, we all know, is sunk costs.
Yeah.
They view that as they're still trying to monetize that money they spent over the last 30 years. And that's a concept I have a hard time understanding. And the other thing is that when you look at the redundancy and the various amounts of people and staffing that are required to maintain an older generation system, it's mind-boggling, and it has a profound impact on your bottom line.
Yeah, no, that's exactly right. And of course, reliability in some businesses is really a key piece, as I kind of illustrated a minute ago. But no, you're right. There is a notion that you can't throw away something you already bought, which is kind of like the way my mom felt from being growing up in the Depression, you know.
Yeah.
And you have to. And of course, you talk a lot, Ed, about you have to take a look at your investments and your capital expenditures, and calculate what your return on that capital is, not in one lump sum, but project by project, or maybe even item by item, so that you can determine really what you're spending and what the return is. It might be difficult to know how much the return is on a full-blown integrated system. But that's probably because people are not keeping track of how long it took to do it manually versus how long it takes to do it with the system. So it's a matter of lack of measurement more than it is decision making, it seems to me.
Well, sometimes, though, the owner was involved with developing that system 30 years ago.
Right.
And remember, 30 years ago, the technology was very rough.
Yeah.
There weren't systems for a lot of these businesses. So these business owners had to spend a lot of money, use a lot of ingenuity to come up with something that was going to work.
Yeah, that's right.
They are physically bought into it. They can't change because they've been involved with it for 30 years. To them, it's simple. To a new person coming into the operation, it could take 10 years to learn how to operate and optimize the system.
Right.
But to the owner, it's simple. He understands it. But the thing is, nobody else does.
But
Where's that lift?
It'll be fully depreciated by the time you train him. So, that'll make it all right.
Yes. And they just don't have the knowledge of what's going on in technology. And the other thing is, when you have a technology, you need people to support it. And more importantly, you need people to make it better.
Yeah.
It's got to be continuous improvement on that system, which requires a staff. And that staff can't be totally reliant upon one person.
Right.
Because if that person's not there, guess what? Company's in jeopardy of losing its franchise.
Yeah. I happen to listen to a very interesting talk by Peter Thiel, who was one of the main PayPal founders, and he went on to found several other companies. I think he was the first investor in Facebook. From hearing him speak, it became very apparent that, his driving force as an entrepreneur is not that he knows how to go out and do it, but he's a person who looks very carefully at the market, and he even though he's an attorney, he took some coding classes. So what he did is he understood that he could get other people to do what he wanted through coding, and therefore his whole business process is, how do I build a system to transform an industry? In other words, I'm going to use a digital business to change an industry. The average owner today is saying, I'm in the widget business, and that's what I do. They're not thinking, how am I going to change this into the super confabulated digital widget? That's not where they're at. They want to sell the widgets that they currently have. So I worry a little bit, and just in terms of the current generation of owners who are trying to get out of business. Now it means for these sort of digital folks that understand it a little bit less, it means you're going to be able to buy these businesses for less money, because they're worth less money if you don't have these systems. And if the company hasn't progressed down the road, so their people, are not afraid to use the computer and to innovate and actually create some of these systems themselves, then you're going to have to change the culture. And changing the culture is an expensive venture, as we all know, and we all know how often that can fail. So,
right, yeah. What's the old adage from King? I can't think of the book right now, but basically he says, strategy or culture eats strategy for breakfast. Right.
Yeah. And so those are the five things. This has been a really fun exercise for me, and I enjoyed doing it. I was a little surprised at what I came up with, and in terms, of course, these are all things that we've done for a long time, but to apply it specifically to, what are we going to look at when we buy a business, I thought it was really fun, and I think I can make a better decision even now, just going through the exercise and looking at businesses. I think we'll make a better decision just having gone through the process.
Well, that's good.
As a summary, maybe we could agree upon this, and that is, we're looking for a business, or buyers should be looking for a business that they can add significant value to. If you can't add significant value, you probably should look for another business.
Right.
So that's the key. It's based upon what your interests are and where you think you can make a major contribution to the bottom line and the balance sheet for improving that business. Yeah. And if that's the case, all thumbs are up, and everybody should be in. Let's get it going.
Yeah, and it takes work. It takes work for the buyer to go through, and they have to realize, a venture capitalist only accepts like 1 out of 12 plans, I understand, and an average buyer probably doesn't look at 12 businesses. And in somebody who's selling his business, probably will sell a business before he has 12 people look at his business, right?
Well,
So,
yeah. And
go
the
ahead.
irony on that is that he may not have 12 people look at his business, and the sad part is that 80% of these small businesses, end up not selling at all. They just go off the books. So a
Right.
lot of what you've said here is very helpful in terms of, the hard part is that the businesses that we're trying to reach, make these decisions and reach out to us or to a broker and say, well, look, I want to sell my business. And they never do any of the things that we're talking about here that really create value. And my hope is that as we move forward, people are listening to this and are able to realize that they can do a lot to transform their business in a relatively short amount of time. If they want to sell in 3 years, we can double or triple the value of the business by working together and helping them, do some of the things we're talking about here.
Yeah.
And you can double or
That's right.
triple the size of the business on the EBITDA side, but more importantly, based upon what Ron said about the life cycle of a business and the special uniquenesses of running a business, you can change the multiple. Instead of a multiple of 4, which is used for a lot of businesses, just think the difference in the value of that business if you can change that multiple to a 10.
Right.
Yeah.
That's where the real money is, and that's where you have to be smart, and you got to utilize these concepts. And I would say one other thing that Ron hasn't mentioned, but I think is extremely important, and he will agree to this. You have to have an ongoing marketing plan. And I'm not talking about a promotions plan. I'm talking about a real marketing plan and a way of tracking the results of new customers and old customers and how you're trying to gain more customers. You need a marketing plan, and it isn't a quick fix. It's an ongoing process. But every year in existence, you add so much more money to the bottom line.
I really agree with that. Of course, as you know, I would agree. I would just only add an interesting caveat, and that is that if I'm looking at a business to buy, I know I can build the marketing plan better than they did anyway. So, that's why it's not one of the 5 on the list.
Well, I realize that, but to us who are thinking about buying a business with you, that's real money.
Yeah, no, you're right.
Yeah.
You're right.
Well, this has been a real good session. We appreciate it. Is there anything else you guys want to add before we draw to a close and invite people to the next session, which will be held a week from Monday? Is that right, guys?
Yeah, that's correct.
Okay.
Week from today, that happens to turn out.
Yeah.
So I would only say that we have on the screen, we've got contact emails for each one of us if you have a question or would like to contact us in any way. And you can go, you can visit us at MicroGiants.com. And the best way to find the whole series of these 3 amigos really expert videos is to type in MicroGiants Mentoring in YouTube's search channel, and that way you'll be able to find it. We have a channel there that is growing every day, and we're getting higher and higher all of the time, but those are the keywords that will get you there today. Hopefully it'll be just MicroGiants in the future, but you're going to find a lot of like ants, giant ant movies and other things in there if you don't put mentoring in, and probably not find us among the small giant movies and scary movies, etc. So yeah, and be sure if you go to our channel, be sure to subscribe and hit the little bell so that we'll notify you as we post the new ones.
Well, one other point, if you have any interest of having someone take a look at your business and look for opportunities for you to get more profitable and increase value, we'd love to talk to you.
Okay, we can leave with that then. Thank you.
Right.
This is a good
Thank you
session.
very much, guys.